boom. In the dead of night, jets screamed over Iranian skies. Within minutes, the world's financial heart skipped a beat. Israel's Operation Rising Lion wasn't just a military move. It sent shockwaves across global stock markets, wiping billions in market cap within hours. Oil spiked, gold surged, and panic selling began. Missiles hit Tehran, and portfolios bled in New York, London, and Mumbai. But hey, before we get into this geopolitical chaos turned market meltdown, quick note. This video took more rewrites than UN peace talks and more coffee than Wall Street traders during earnings week. So if you're enjoying this ride through the chaos, smash that like button and subscribe. Within hours, global equity markets nosedived. The Dow Jones fell 650 points. Brent crude surged past 94 barrel, and gold jumped 3% overnight. The Indian Sensex and Nifty opened with a gap down, mirroring the fear that swept across Asia. Markets hate uncertainty, and war, especially in the Middle East, equals uncertainty on steroids. This wasn't just about missiles. It was about potential oil supply shocks from the Strait of Hormuz, where 20% of global oil trade passes. Traders dumped risky assets and rushed to safe havens like gold and the dollar. Defense stocks rallied, energy stocks surged, and tech stocks tanked. Think of history, and we have Gulf War in 1990 or US-Iran tensions in 2020, where the markets had a dip followed by high volatility. This environment necessitates a cautious and analytical approach to portfolio management. Risk assessment and diversification are critical considerations for investors. Evaluating exposure to energy markets and defense sectors is prudent. Conversely, positions in sectors vulnerable to economic slowdowns or supply chain disruptions warrant careful review. Maintaining adequate liquidity allows for flexibility in responding to market shifts. Strategic adjustments based on evolving geopolitical developments are essential. The market's trajectory hinges on the de-escalation or further intensification of tensions. Analysts are closely monitoring official statements and regional responses. Economic forecasts must now incorporate a higher degree of geopolitical risk. Potential impacts on inflation, supply chains, and global growth require careful modeling. Investors should prioritize robust due diligence and seek informed perspectives. Navigating this complex landscape requires patience and a long-term strategic view. Stay informed on geopolitical developments and their potential economic ramifications. Conduct thorough analysis and consider adjusting your investment strategy based on your risk tolerance and objectives.